happy to see all of you here, and thank you for taking the time for joining me here in my webinar. I know it's already 7 p.m. here in California, and some of you are following Central Time and Eastern Time, so thank you. I really appreciate your time. So today, I want to share you a webinar about multifamily real estate investing while working full-time. Just a disclaimer before we start, this webinar is intended for educational only, and please don't use this as a legal, accounting, and investment advice. I am not trying to sell or solicit any investment opportunity, so please do not invest in anything that I am going to say unless you talk to a professional advisor. First, I want to start telling you more about myself. For those of you who don't know me, my name is Glee Custodio. I started being a nurse 10 years ago. I've been a nurse for 10 years. I got into healthcare because I really care about people. Do you guys want to share what you do, Sanjay?
Can you hear me?
Yeah, I can hear you.
Oh, yeah. Hey, Glee, I am Sanjay 𝐆𝐔𝐄𝐒𝐓. I am in North Carolina, and I'm also very much like you. I had a W-2 job as well, and was working in sales all along. So I've been a director of sales, vice president of sales, and I also do consultancy for the battery industry, and also do investments in multifamily syndications.
Nice. How about you, Edward? Oh, Edward left. Sanjay, it's just you and me.
That's okay. That's a good thing. Let's do it. Don't worry about it.
No. There are 4 participants. Hold on. Oh, Balbo is here. I guess let's just wait for everyone.
Sure. You want to pause it instead of recording it?
Mm-hmm. All right. All right. Hi, everyone. I'm so happy to see all of you here, and thank you for taking the time for joining me in this webinar. I know it's already 7 p.m. here in California, and some of you are following Central Time and Eastern Time, so thank you. I really appreciate your time. Today, I'm going to share with you a webinar about multifamily real estate investing while working full-time. Just a disclaimer before I start. This webinar is intended for educational purposes only. Please don't use this as a legal, accounting, or investment advice. And I am not trying to sell or solicit any investment opportunity. And please do not invest based on what I'm going to talk about in this webinar unless you speak to a professional, financial professional. First, I want to tell you more about myself. For those of you who don't know me, my name is Glee Custodio. I have been a nurse for 10 years. I got into healthcare because I really care about people. Anybody wants to share what you guys do here? Pao, do you want to share what you do?
Oh, hi. Yeah, so I'm a real estate professional. I invest in single family in the Bay Area. Used to fix and flip, but now I do apartment investing in syndications.
Nice. How about you, Himoto? Sorry, I can't pronounce your name correctly. Do you want to share what you do aside from real estate?
I come from the corporate world, sort of luxury retail and things like that, but it's, kind of like a hamster on a treadmill.
Mm-hmm.
If you don't sell, you don't get paid,
Mm-hmm.
To me, time is more valuable. Time freedom is more valuable than just working all the time. So what's interesting to me, what really interested me about your presentation was about if you're working full time, how do you find time, to do all that kind of stuff? And then, I'd like to hear kind of how other people are balancing transitioning into something like this, because all these podcasts you hear, oh, you only need to give an hour a day. It's bogus. There's no way you can do something like this just an hour a day or 5 hours a week. I mean, this is hard work. It's very hard work. And, you know, that's something that you hear a lot of gurus painting that rosy picture.
Nice. So basically, most of us are doing real estate here. That's nice. Thank you for sharing. So my passion for nursing started when my mom had her first heart attack when I was 17 years old. It was just her and me when it happened. When I got into the hospital, the moment I stepped into the room, they told me, "We saved your mom." So that statement was an eye opening for me. I told myself that one day I want to say that to my patients and their families as well. I enjoyed every minute of working in ICU and helping patients who were very sick. And for me, nursing is a very rewarding job. But during the pandemic and now the shortage of nursing in all of the hospitals, I found myself working longer hours to help on top of working in a very harsh environment. And also, I had to work extra shifts to make extra money. Then I realized that me working long hours is not sustainable. It was affecting my work life balance and affected me emotionally. So I started looking into how I could make passive income. Because like for me, make money by investing, not working and getting paid hourly. And that is how I learned about multifamily real estate investing. I am reaching out to you because this could happen to you too. And I like to share my experience as well. So my real estate journey started in 2017. I started in a single family home. I co-founded Homesphere Investments. And this year I became a board of director of Asian Real Estate Association of America. So now my goal is to help busy professionals generate passive income. Some of the topics that I am going to be talking about in this webinar to really level up your passive income investment journey are how real estate makes your money work for you, how to generate passive income through multifamily real estate investing, understand if your investment is active or passive, how multifamily syndication works in practice, understand the pros and cons of multifamily syndication and the risk of investing in real estate syndications and how you can avoid or minimize them. So why did I venture into multifamily real estate investing while working as a nurse? So achieving my goals became easier because they were meaningful and connected to a reason and purpose, which is my why. My strong why is my key to staying focused and motivated, even if I wanted to give up several times because it's hard to do. My greatest why is my family. Being first generation immigrants, we don't really have wealth, so I want to get out of that rat race and create generational wealth for my family. And also, I want to be free for my future family, especially when my kids start having school activities. I want to be available for them. I want to be free for them and spend more time with them. I also find myself working a lot of extra shifts on top of my full-time hours just to get by. So I was working 5 long shifts in a row to make extra money. And I just don't want to keep working hard for money all my life. I don't want to keep trading my time for money. I don't want to keep sacrificing my holidays, my weekends, and sometimes my sleep at night. Because before I was working night shifts, so I just want to give those up. I simply want to work as a nurse because I want to, not because I have to. And also, COVID-19 taught me to have multiple income streams. We know what happened during COVID. When COVID started, we've seen it. A lot of people lost their jobs. A lot of people were furloughed, and a lot of people had their hours reduced during the pandemic. So it's wise to have multiple income streams. And because of those extreme situations, my wisdom and perspective emerged. I realized that the rare hours I had to recharge at home were my lifeline. And after working 40 hours a week, the quality of my care diminished. So by creating passive revenue streams, I could afford to work less but better and actually enjoy myself at work. So what actions have I taken to generate passive income? When I was in nursing school, I knew I wanted real estate. I'm always fascinated by buildings and renovations. I always want to own rental properties, but I didn't have the money to start with. So I started with single family home. I renovated and rented out my rooms. I am an investor myself. I invested in other multifamily syndication deals using my self-directed IRA. So for those of you who don't know what self-directed IRA is, it's basically the same as traditional IRA. The only difference is you have a control where you want to invest your money aside from stocks. Like you can invest your money in real estate, you can put it in cryptocurrency, oil, or gold. That traditional IRA doesn't allow you to do. That's why it's called self-directed IRA. So now is the time for me to scale up. Doing both healthcare and wealth care has been the greatest decision of my professional life. Our ultimate goal is to generate passive income, have your money work for you, have a control of your time and your life, and have a financial independence. The goal is to create progress no matter how small it is, and eventually it will build momentum. And the younger you start, the better. And when you invest in income generating assets, you can use the profit from that investment to pay off your debts or even fund your retirement. Do you agree with me? Feel free to comment in the chat box and let's keep this conversation going. So our first lesson is about how real estate makes your money work for you. As we know, over the years, every dollar that we invest in real estate, every dollar that we invest in real estate, our money works hard for us. So these are the 6 pillars. Each dollar that we invest works hard for us. So when we invest our money in real estate, we are taking advantage of leverage, cash flow, appreciation, forced appreciation, tax benefits, and equity. So let's go over the first pillar, leverage. Leverage is when you don't use your own money. You use someone else's money. Let's say you can borrow from the bank, your investors, and private lenders. Let's go over an example. Let's say if your rental property is 200,000, you'll put 20% down payment, which is 40,000 down, 40,000, and the bank is going to lend you the remaining 80%. And in some cases, you can even start with as little as 3% as a down payment. Next pillar is cash flow. Cash flow is the money you take home. It is the amount of money you have left after all expenses have been paid. Let's use a rental unit as an example. The tenants pay the monthly rent, which covers all the expenses and mortgage payments and provides profits to our investors, which we typically distribute quarterly. What I want you to remember from this pillar is that cash flow is king. And it is important to understand that we prioritize buying rental properties based on the cash flow, not appreciation, although appreciation is a bonus. Third pillar, appreciation. What it means is real estate value goes up long term, but short term it can fluctuate. But if you look at the historical data, real estate goes up in value and it becomes more profitable. Now that we know appreciation will increase your return on investment, you can force appreciation by doing renovations and adding amenities. So this not only increases appreciation, but also increases cash flow. And that's what we call forced appreciation. Next is tax benefits. Our goal here is to take as much profit as possible from this transaction. So far, we have discussed how we increase the value and cash flow. Now we want to talk about how we can lower or avoid taxes by investing in real estate. I want to tell you about cost segregation. Similar to forced appreciation, we want to force depreciation when it comes to paying taxes. So what is cost segregation? Cost segregation is a strategy to accelerate depreciation of properties, creating larger losses and decreasing your taxable income. What it means is the structures wear down over time and the government provides us tax credits. But we all know that real estate goes up in value rather than down over time, and it becomes more profitable. So why do you think rich people own real estate? Anyone have an idea? Want to
Yeah,
comment?
save on taxes.
Yeah, because the IRS loves real estate investors, right? Now let's talk about the last pillar, equity. Equity is your cash value when you subtract how much you owe from how much you are worth. Let's your market value of the property is your worth. You subtract your mortgages and other liens that you owe, and the difference is your equity. Example. Let's say the value of your property is $1 million. You subtract 20% down payment that you put 200,000, and let's say you have a balance of 300,000. Then the equity you have available is 500,000. Our next lesson is about generating passive income through multifamily real estate investing. Passive income sounds like a pipe dream for many people. It means that you can make money while you sleep, and it's a great way to build wealth over time. But where do you start? Where do you even get started if you don't have the money? So I was in that situation when I was in my early 20s. I thought I needed to be a millionaire to own an apartment building. I didn't know I can start making passive income by investing in multifamily syndication deals. So, and most of those multifamily syndication deals, they allow you to invest with 50,000 or even 25,000 to begin with. And there are ways that you can start investing. You can borrow, you can invest from your savings account, you can borrow from your retirement fund, and even borrow from a home equity line of credit. So why am I targeting medical professionals and other busy professionals? We know that a healthcare job is stable and it's a great way to make money. The problem is that we have to work long hours. We have to sacrifice our weekends, our holidays, and even sometimes work at night, which makes it difficult for us to actively invest in real estate. But there are ways that you can be both healthcare provider and an investor like me. Like for me, nursing is my active income and real estate is my passive income. And my goal is to reverse nursing to real estate. Eventually, I want to do nursing as my part-time and real estate as my full-time and retire early. So by investing in real estate, you don't have to deal with working night shifts and deal with nighttime calls that we do at the hospital. So this slide is about a problem that I encountered while talking to people about multifamily real estate investing. I realized that there's a challenge between making money from working full-time and making passive income by investing passively. A lot of people only know the traditional way of making money and relying on traditional IRA to retire. So this is how I came up with the problems, and I realized I needed to nurture the people to change their mindsets. So the aware problem is a lot of people don't know how to generate passive income by investing in real estate because they don't know where to start and how to educate themselves. So the unaware problem is people are overwhelmed. They have fear of losing money if the market crashes. A lot of people mistrust others to manage their money. Passive income sounds good to everyone, but also a lot of people lost a lot of money through investments because they didn't know how to find and evaluate the investments to see if the investment is right for them. So what people ended up doing is people rely on one income source, and that's sad. What if you are only making money if you go to work? What if something happens to us? What if we don't have enough money to retire sometime in the future? And what if another COVID-19 comes again? Do we even think about those things? So I want to change that negative perception and the fear that people have. And my suggestions to go through those fears and uncertainties, do your research, ask questions, you network with other investors, you can review previous deals and take your time. Don't just invest without educating yourself. And that's how you can minimize the risk of investing. So I made a case study about active versus passive investing. Ben is one of my investors. He's a high income earner, but he pays a lot of taxes. He's a busy doctor. He's busy with his job as a doctor. So he only has time to invest in stocks and other retirement investments. When I talked to Ben, he was frustrated when he came to me as he has savings in the bank account but not generating any yield. He also lost a lot of money from stocks and crypto, so now he wants to invest in real estate, but he has no strategy and he doesn't have time to do active real estate investing. We will find out later what he ended up doing. If you guys are interested in learning the strategy to generate passive income by savings from your savings by real estate investing, feel free to schedule your strategy session with me. We will get your questions answered based on your expectations and your goals. You can leverage my expertise, my experience instead of creating the wheel. I will share you the link in the chat box of my Calendly. Oh. Here you go. I just sent my Calendly link. All right, our third lesson is about understanding if your investment is active or passive. So I want to emphasize that not all real estate investing is passive. Making a clear distinction between active and passive is what most new investors fail to distinguish. I fell into that trap when I bought my first single family home investment. I was more involved than what I thought. Managing my tenants and cleaning were not fun at all. So I don't want to do it again because of the challenges I have faced, and it's hard to scale doing single family home investments. The difference between active and passive is active investing is you run the show. It's basically a hands-on approach. Your role is finding the deal, managing the property, and dealing with the challenges. Examples of active investing is your single family rental property, flipping houses, and wholesaling. While passive income is basically a hands-off approach. Your role as a passive investor is to bet on the opportunity in the beginning, and then after that, the sponsor is responsible for the rest. Example of passive investing is syndication, REITs, and crowdfunding. So why do you think active is not good? Is not a good route for 80% of professionals? Because it requires more time and energy than you think, and it's difficult to scale. So I have talked to a bunch of professionals who are busy with their full-time job with active investment, and I asked them if they would do it again, and most of them said no because of the challenges they faced. They bought their first single family rental property, and they are not getting the rental payment, so now they are scared to manage the property and tenants themselves. Active is for you is if you have extra time being a landlord, or if you just want to experience owning your own rental property. Active is for you if you want to switch your career to real estate as your full-time job, or if you are just curious and you don't mind the challenges. So in this case, you will be rewarded with high returns. I've done it and it's great. I just don't want to do it again because of the challenges I have faced. On the flip side, if you are not interested in learning the ins and outs of real estate and you have the lack of time to find and support your own deals, then passive investment might be the way for you to go. So here are the benefits of passive investing. Zero time involvement after investing. I see it as a set it and forget it type of real estate investment. With passive investing, you do some upfront research and betting on the deals, but once you invest, you don't have to put additional time. Minimal time upfront to vet the deals. So basically, you just need to do your due diligence and research before investing in deals, and you don't have to build a local team from scratch. You don't have to make decisions, take phone calls, or get involved in a day-to-day operation. Basically, the general partners will run the show. You just receive cash flow while you sleep. Fourth is tax advantages. So here, you'll be able to write off most of the cash flow distributions you get during the life cycle of the investment. Fifth is you limit your liability. Your liability is limited as a passive investor. The only risk here is if you invest 50,000, the biggest risk is losing that 50,000, but you can't lose anything beyond that. You are not on the hook on the entire value of the property, and your other assets are also not in jeopardy. Next is scalable. So active investing is the way I started investing, but it will take me years to scale to get another property myself. Plus, it's easier to manage 100 units in one complex than managing 100 rental units in different locations. And last is diversification is easier. You can get to diversify your portfolio. As you know, it takes a lot of time to become an expert in a market, as well as searching for job growth, searching for population growth, and even visiting the properties itself. It's very time consuming. You also need to build relationship to the brokers and property management company, which could be a hassle. So by investing with experienced syndicators, you leverage their expertise in the market, allowing you to diversify more quickly and easily. So if you are still undecided if you want to be an active or passive investor, I totally get it. There are a lot of things to consider, and deciding where to invest your money is a tough decision. So here are the few things that you should consider when deciding whether you should be an active or passive investor. First, the 3 T's of real estate: tenants, termites, and toilets. Do you want to deal with those 3 T's? As a landlord, you have to deal with screening your tenants, dealing with tenants that are not paying rents, marketing your own property, and even rolling up your sleeves to fix or improve the property. So if those things excite you or terrify you, just think about it. Second is time. How much time do you have? Active real estate investing requires time from acquisition throughout the cycle of the property. With passive investing, you do some upfront research and vetting, but once you invest, you don't need to put any additional time. Third is involvement. What level of involvement and effort are needed? As an active investor, you decide on renovations and home improvements, you screen the tenants, you find your own team. As a passive investor, you put your trust to general partners to do everything. So think of it as an airplane ride. The active investor is the pilot, and then the passive investors are the passengers. Everyone on the plane is going to the same location, but their levels of control and involvement are different. Next is profit. What kind of potential returns do you expect? So as an active investor, you put in the time and work, so you're rewarded with high returns. As a passive investor, you share the profit with other people, but that doesn't mean that your profit is lower for being a passive investor. It just depends on the deal, the market, the loan terms, and other aspects. Next, risk and liability. What level of risk and liability are you willing to accept? So what if something happens to the property and someone wants to sue you? As a passive investor, your liability is limited. You are not held personally liable. The only worst scenario that could happen is you could lose your original investment, but your other assets are not in jeopardy. And then paperwork. Do you want to do a lot of paperwork as an active investor, or do you want to be just a passive investor? Like as a passive investor, you only need to sign up for the document up front, and then you're going to read the email updates monthly, and then read the quarterly financial reports and deal with the K-1 form every year when you file your taxes. Next is team. Do you have the right team? As an active investor, you put together your own team. As a passive real estate investor, you invest in a team that's already put together, so you leverage their experience. And last is diversification. You're able to diversify your investments easily. As an active investor, you may be stuck with one rental property for a long time, but as a passive investor, you can invest your money in different deals and you just sit back and receive cash flow. And on the impact side, you should decide whether you want to have a broad or deeper impact. As an active investor, you have a deeper relationship with your tenants. That's what you desire. So you may end up being friends with your tenants, or sometimes you may end up being a family member to your tenant, but just be aware that being friends or family with your tenants could be difficult. So as a passive investor, because you are able to invest in bigger projects, your money can go further and has the potential to impact your tenants by making their place a nicer place to live. And you don't have direct contact with them. So going back to Ben, I told him to spend more time on the questions and do a little more research and pick one strategy. Either he wants to do active or passive for now. So Ben decided in the end to do passive investments. He decided to invest in syndicated deals because he's already busy with his job. So this saved him time from looking at the deals he wanted to buy directly. You can always switch if you want to do active or passive investing. It's not like you have to stick with one, but in the beginning, it's better to have one strategy and have a 1-year goal. And I also know other people are doing 10 deals per year in hopes that they will double their money in 5 years without doing anything, instead of doing their own rental properties. So our next lesson is about understanding how multifamily syndication works in practice. Here, I'm just gonna play the animated multifamily syndication video that we already have on our website to explain how multifamily syndication works in practice.
It's frustrating when you find the perfect real estate investment, but aren't able to secure the necessary financing. Real estate can move quickly in today's market, and there's no time to waste waiting until you have the required capital. Fortunately, there's a solution: real estate syndication. Let's start with the basics. So, what is real estate syndication? Real estate syndication refers to a group of investors that pool their money to build or purchase property. Players in this partnership are the general partners and limited partners. The general partners put the deal together and are responsible for managing the show. Typically, it is a group of real estate professionals with strong ties to multifamily brokers who find promising deals in emerging markets, underwrite them, negotiate with sellers, perform due diligence, file SEC documents, and secure the equity and the financing. Basically, do everything that's needed to run the syndication. On the other hand, limited partners are passive investors who invest their money in return for equity in the deal. How our investors get returns? Our company usually employs a 70-30 straight split, with the limited partners owning 70% of the deal. The targeted returns for limited partners are over 8% average cash-on-cash return, over 20% average annual return, 3 to 10-year holds. Every quarter, the limited partners will receive distributions and the general partners will issue an update on the property to keep investors informed on how the investment is performing. At Homesphere Investments, we specialize in upgrading assets that are in emerging markets to elevate our tenants' living conditions and provide high yield returns to our investors. Our strategy relies on value-add programs, acquiring, renovating, raising rents, holding the property and distributing returns, and selling with massive upside. If you're looking to diversify into the only cash flowing assets that actually reduce your tax burden and are safer and more stable than the stock market or cryptocurrencies, now is the best time to educate yourself. Start by visiting our website at homesphereinvestments.com and contact us to find out more about how to partner with us. Or if you have questions about how passive income and multifamily investing might make sense for your investment portfolio.
All right. All right, now that you've seen how multifamily syndication works, we also have blogs on our website. You can read the blog that we wrote about deal analysis, deciding to invest in real estate syndication. There are also other resources on our website. Feel free to read them to educate yourselves. Sorry, I'm trying to fix my screen right now. There we go. All right, so what returns are you gonna get if you invest? So everything that I'm gonna talk about in this section is only projected returns. As with any investments, we cannot guarantee any returns. So this is only meant to give you a ballpark of the kinds of returns we typically see. So let's start with projected hold time. Projected hold time is the amount of time we plan to hold the asset before selling. We usually hold our assets for 5 years. Usually the projected hold time is 3 to 10 years, but a lot of syndicated deals are 5 years. Why 5 years? We find that 5 years is a good length of time for our investors and long enough to see healthy returns. In addition, given with the real estate market cycles, 5 years is a good timeline for us to get in, to renovate the property, and give the asset and market a little time to appreciate before selling. Plus, commercial loans are often 7 to 10 years, 7 to 10 year fixed term. So if we hold our assets for 5 years, that gives us a little buffer to hold the asset if the market crashes or something happens like recession. Our next core metric that we look at is projected cash and cash returns. So this is basically the cash flow that you get while you sleep. For our projects that we're looking at, we like to see the cash on returns about 8% or 18 to 20% average annual return. So that is, if you were to invest 100,000, the projected cash and cash returns would be about 8,000 per year. The next metric is projected profit upon sale. So for the projects we typically invest in, the projected profit at the sale is around 40 to 60%. So at this point, we already renovated the units, the tenant base is already strong, and the rents are at market rent. So now we're ready to sell the property. And just letting you know, commercial properties are valued based on the amount of income the asset generates compared to single family homes. Single family homes are valued based on the market. So there's a difference there. So sticking with the previous example, if you were to invest 100,000, you would receive 40 to 60,000 in profits of the sale of the asset in 5 years. So this is on top of the cash and cash returns you're receiving throughout the whole time. To summing it all up, if you were to invest 100,000 in real estate syndication with the projected returns that we talked about, you would end up with roughly 200,000 at the end of 5 years. So 100,000 of your original investments plus 40,000 in cash and cash returns plus 60,000 in profits upon sale. So you would end up with 200,000. try to ask that from your savings account, double your money in 5 years, and let me know how it goes. Our next lesson is about the pros and cons of real estate syndication. So just like other investments, real estate syndications also come with pros and cons. So if you're asking whether real estate syndication is too good to be true, then that means you're thinking critically about real estate syndications as a potential investment, and you're just doing your due diligence, which means you're pretty smart and savvy investor, which is good. So the advantage of being a passive investor, you don't have um, you don't have responsibility. You don't have active responsibility to deal with your tenant turnover. You don't have to deal with renovations or late night phone calls, but you don't have any control over the investment. Basically, the general partners will operate the property and asset manage the property. So it involves a certain level of trust. Another advantage is long-term investments with projected hold time of 5 years. So that means you don't have to think about it for a while compared to cryptocurrencies and stocks. You look at it every day. Like when you wake up in the morning, that's the first thing you look at, right? But you cannot pull your money as you do with stocks and cryptocurrencies. Another advantage is you sit back and collect cash flow. But the down part is you share the overall pot of returns with other investors in the deal. So what are the risks of investing in real estate syndications and how you can avoid or minimize them? So as with any investment, like I said earlier, there are also risks involved in syndication. So avoiding this risk will provide you with peace of mind when you invest your money. The first risk is you could lose your original investment, but the risk of losing all your money is slim. But you may just not get the returns that the syndicator told you in the beginning. So what solutions can you do? You can diversify your investments among different markets as well as different syndicators. Why? Because if we are in a recession, each market would be impacted in different ways. By spreading your investments across several markets, you will minimize your overall risk. And also by investing with different syndicators, you will have the opportunity to participate in deals that have unique investment criteria. So, and also make sure you do your own due diligence before you invest and look for a syndicator who takes a conservative approach. Look at how the syndicator analyzes the exit cap rate versus the in-place cap rate. So that's an important factor to look before investing. Always ask the syndicator what cap rate they purchased a property and at what cap rate they are predicting it to be. So conservative syndicators, they underwrite the exit cap rate at least like 1% above the in-place cap rate. And finally, look at how the syndicator makes their occupancy assumptions. So when the syndicator states that the occupancy level would be 97% of 100%, that's just not conservative and it's not reasonable. And also make sure they factor in the tenants who are not paying. Another risk is losing your passive investor status and legal protection. So never play an active role in managing the asset. The only areas that you shouldn't be passive about the deal is doing your research about the deal, making your research about the market and the sponsors. Next is avoid lack of transparency by talking with a syndicator before you invest and have an understanding of how often and in what form they will update you with your investments. Make sure that you're okay with monthly updates and sharing financial reports on a quarterly basis. Next is risk of execution. You should invest with investors who have a proven track of record and who prioritize capital preservation. So when we choose markets, we look for areas where there is a job growth, population growth, and because if there's a job growth, when you're adding jobs, you're adding people. And when you're adding people, that of course is good for real estate, right? When you're adding people, that increases the demand for housing and that will increase the rents. That's why we look for those kind of markets. Preserving our investors' capital is our #1 priority above and beyond any shiny projected returns. Next is changing market condition. So like I said, it's good to invest in to diversify your investments in different markets and make sure there is a loan buffer time. If let's say the projected hold time is 5 years, check the long term. It should have at least 5 years or longer than that. So in case we need to hold the property, we have a buffer. And that's it. Congratulations. Thank you so much, guys, for staying until the end. So we have a webinar. We just don't know yet when. It's going to be about investing in multifamily real estate, a beginner's guide. So feel free to sign up to our next webinar. Do you guys have any questions? Guys, do you have any questions?
No questions, Glee. I think the only thing that I could tell is, I think when you played the video, at least I didn't get to see the video. I don't know about the rest of them.
Oh, really? Oh, I'm sorry.
Okay.
Maybe I'm gonna play it again. Do you guys want me to play it again?
Sure.
Okay, I don't know what happened. Hold on.
Yeah, we could only see the.
All right. Oh, here. Sorry, I should have known.
It's frustrating when you find the perfect real estate investment, but
Yeah,
aren't
I
able
still
to
can't see
secure
it.
the necessary financing. Real
Can you see
estate
it
can
now?
move quickly in
Nope.
today's market.
Oh yeah,
There's
now
no
yes.
time to waste waiting until you have the required capital.
All right. Can you see it now?
Fortunately,
Yep.
there's a solution.
Okay.
Real estate syndication. Let's start with the basics. So, what is real estate syndication? A real estate syndication refers to a group of investors that pool their money to build or purchase property. The key players in this partnership are the general partners and limited partners. The general partners put the deal together and are responsible for managing the show. Typically, it is a group of real estate professionals with strong ties to multifamily brokers who find promising deals in emerging markets, underwrite them, negotiate with sellers, perform due diligence, file SEC documents, and secure the equity and the financing. Basically, they do everything that's needed to run the syndication. On the other hand, limited partners are passive investors who invest their money in return for equity in the deal. How our investors get returns? Our company usually employs a 70-30 straight split, with the limited partners owning 70% of the deal. The targeted returns for limited partners are over 8% average cash-on-cash return, over 20% average annual return, 3 to 10-year holds. Every quarter, the limited partners will receive distributions, and the general partners will issue an update on the property to keep investors informed on how the investment is performing. At Homesphere Investments, we specialize in upgrading assets that are in emerging markets to elevate our tenants' living conditions and provide high-yield returns to our investors. Our strategy relies on value-add programs, acquiring, renovating, raising rents, holding the property and distributing returns, and selling with massive upside. If you're looking to diversify into the only cash-flowing assets that actually reduce your tax burden and are safer and more stable than the stock market or cryptocurrencies, now is the best time to educate yourself. Start by visiting our website at homesphereinvestments.com and contact us to find out more about how to partner with us. Or if you have questions about how passive income and multifamily investing might make sense for your investment portfolio.
So Glee, it was very impressive. I have a question. How do you balance your work and syndication part of it? Like, do you allocate a certain time? Because I understand it must be very difficult. How do you manage that?
Yeah, so it's difficult on my part. I'm kind of biased because nurses only work 3 days a week. So we do 12 hours a week. So before I was doing a lot of extra shifts, I didn't have time. But now I stopped working extra shifts by making passive income. So now I have 4 days off to do real estate.
Awesome.
Yeah. And also I have a partner who's very great. He's not here right now. He wasn't able to join the webinar because he's in France, but he's really amazing.
See, that's good thing, right? Passive
Yeah.
investment. Let's him go to France, right?
Yeah.
Nice.
Yeah, but on our next webinar, he's gonna be here. He'll join me.
Awesome. Awesome.
Do you guys have more questions? Any questions, guys?
Can I ask a question?
Yeah.
So thank you for your presentation.
Yeah, you're welcome.
So one thing I'm curious, you as a GP, obviously you're having to present any deals that you find to prospective investors, right? To invest in your deal.
Mm-hmm.
Now, especially in the last month with what's the crazy things happening in the capital markets and stuff, right? Interest rates and all this. How are you guys adjusting your returns, or are you, for example, are you getting pushback from investors where they're saying that, we still want 7 to 8% cash on cash, and we still demand 18 to 20% annual return? And are you able to find deals that way? Or do you find that, you're sort of educating investors, or, just like how prices are coming down a little bit, we're kind of fighting with sellers a little bit, right? Because it's more expensive to get the debt.
Mm-hmm.
Are you finding that return expectations are also going down a little bit, where cash on cash could be more like 6 to 7%, and then annual returns can be like 14 to 16%?
Yeah,
I'm
so
wondering.
basically we just pass on the deals that have low returns. Like we don't close a lot of deals right now because of those kinds of returns. But we just tell our investors we buy based on cash flow, not based on appreciation, and we show them how we underwrite the deal. Like we show them that we're pretty conservative. Like we factor in high vacancy, like high concession non-payment, and then we also show them that we raise extra capital. So if you don't use those capital, then the returns are higher, and they're okay with that.
Well, what do you mean by you don't raise the capital, or you don't use the capital? Because you can't use the capital that you raise to pay them back and treat it like it's a return. You know what I'm saying?
Yeah,
I've seen sneaky GPs try to do that, where they over raise and then they actually return some of that capital that should have gone to CapEx, repairs or whatever, but they're using that extra capital and actually returning to the investor saying, oh, it's a distribution, when really it's not. It's just kind of like returning the money that they over raised. So it gets kind of weird, because I got presented with a few deals like that where I was looking at and saying, this seems odd. But just in this general climate, right? Like where interest rates are going and stuff, I appreciate what you wrote about, make sure the cap rate is higher at the refi or higher at the exit. But the big unknown, right, is what's going to happen to interest rates. Whether if you're in a fixed interest rate, fine. But like if you're in a bridge loan, I presume a lot of the deals that you guys have been looking at or doing, the only way to get it done if it's a value play has been bridge.
mm-hmm.
That's where it seems kind of scary, right? Because even though you're doing a 5-year hold, if you went into bridge is a floating rate, and then you got to still refi and hope to God that your underwriting and your prediction for where rates are going to be are accurate, right?
So basically, instead of underwriting with the current interest rate, we just underwrite over 6%, like 6.25%. So that gives us a buffer to investors. And then also we have this what do you call that? If you look at the loan terms from the brokers or the mortgage lenders, they give you like how they structure the loan term after refinance. So we follow that. We just add extra interest rate instead of not giving us any buffer.
Yeah, and that's kind of all we can do, right? Because even the lenders, they don't have a crystal ball either. So we're all kind of guessing. And sometimes I worry that we're killing our own deals because we're like so conservative, so scared. Mm-hmm. That we're just killing deal after deal after deal unnecessarily, because we just don't know, right?
Yeah, so basically you you just underwrite higher mortgage rate, and then that's why it's important to underwrite with higher exit cap rate.
Thank you.
Yeah, you're welcome. Any questions, guys? I guess we're done.
Good job, Lee.
All right. So thank you, guys. Thank you for staying until the end of the webinar. I really appreciate your time.
Thank you.
I hope you got something from this webinar. All right, so I'm gonna end the recording.